So before we even start with anything, let's talk about what is trading, because I know for myself, even when I started trading and I already knew how to use indicators and all this other stuff, I didn't exactly know what trading was. Right? So trading is as simple as it's put, right, by the word. It's trading one item for another, right? Let's say we have, this is an apple. Let's say we're trading an apple for some money, right? Same thing. What we're doing now is we're trading, so if you're doing Forex, you're trading some sort of currency, right, like the euro for dollars, or if you're trading stocks, you're trading part of the company for some money. Now, where does the difference come in between trading and investing, right? Because they kind of sound similar. A lot of people get confused sometimes. Investing is more long-term, whereas trading is more short-term. Now, how is this possible? So, with investing, right, let's say we buy, let's do it with currencies. We can do it with both. We can do it with currencies, we can do it with stocks. With currencies, let's say the euro goes from a certain value, right, and then over time, let's say, I don't know, maybe 10 years or something, it doubles in value. So if you bought the euro at a certain amount, after 10 years, right, let's say you invested $100 into euros, after 10 years, you would be at $200, right? Now, how is trading quicker? Why does it differ? Now, in trading, what they have, everything is calculated in percentages, and what you can do is you can use this thing called lot size, right, or a multiplier. So, if you have the euro, and let's say in 15 minutes, right, in the matter of 15 minutes, the euro was worth, say, let's say it had a 0.00, I don't know, 5% increase, right? So these would be your pips. This would be 50 pips right here, right? For those of you who already know what pips are, if you don't worry about it. I'm going to explain it later. So let's say I had that 50.005 increase, right? Well, if you only put, this is 15 minutes. So if you only put, let's say, $100 into this, after those 15 minutes in investing, you would only have $100.00, not even 1 cent, right? Now this is where your multiplier comes in, because you can multiply the amount of this small percentage and how much it's worth, right? You can say that each small percentage is going to be worth, let's say, $1, right? So every percentage to the 4th decimal place, which is your pip. So by the way, your 4th decimal place is your pip. Okay. If it's in Japanese pairs, it's the 2nd decimal. But so this is the pip here, the 0. So this is 50 pips, right? For each pip, you can say each pip would be valued at $1 per pip. And if this went up 50 pips, well, instead of making this much, you would have made $50, right? $1 times 50 pips, $1 times 50 pips, which is that small percentage increase. You're saying that you're going to value it at $1 each. So therefore, you just made $50. So if in a matter of 15 minutes, you could have made $50. All right. So this is where the big difference comes in, right? 10 years versus 15 minutes, right? It's not the same amount of money. Let's say it was 5 years. So that's where the big difference comes in trading, right? That's where sometimes people fail to understand exactly how this works. It's a very small percentage increase, but you can value it at a certain amount, right? The same thing happens with stocks. So now let's go over what exactly is Forex, right? Why do we trade Forex? Why is it that we're looking at Forex and not stocks or commodities or binary options, for example, right? So why Forex? Now, Forex is the largest financial market in the world. All right, I'm not going to write it out. So what does that mean? Because it's the largest, right? I think it's like $4 trillion flowing around every day. Because it's one of the largest, this means that it's harder to manipulate, right? There's still manipulations. There's always going to be manipulations in economic markets, but it's the hardest to manipulate. So that actually gives us an advantage. That also allows for trends, and it allows for technical analysis to be a lot more comprehensive and to be a lot more accurate, because nature can actually create the trends, just like trends that happen everywhere that you see in nature. Because it's such a big market and it's so much harder to manipulate, then this allows it to actually take shape, and you can actually see things that are going on and kind of foresee the future, right? It's obviously not exact, otherwise we would all be rich, but you can at least kind of see where the market is going. It's a lot easier. So now, why is it that you should be trading, and why is it the biggest financial opportunity of your life? And why is it also the most efficient way of generating income, right? I believe, honestly, so you're supposed to have 7 sources of income, right? The average millionaire has 7 sources of income. The average millionaire has 7 sources of income. Now, which one should be your first one, right? Because you got to start somewhere. By the way, you can't do all 7 at the same time. If you try and do all 7 at the same time, try and catch 7 chickens at the same time, right? You're not going to get anywhere. So you always try and build one source at a time. Typically, if you want, you can rush it and do one every 6 months or one every year. And if you can get it to a large amount or sum of money, once you have that ball rolling, it doesn't take too much to push it, but you have to get that ball rolling, right? Which is the hardest part. So which one should be our first one? I would highly suggest Forex, right? Unless if you already have something built, obviously. Your second one or third one, whatever you're looking at now, definitely Forex, definitely trading. Why trading? Because in everything else that you're doing, right, you're trading a lot. Again, here's the word trading, right? You're doing this. You're trading time for money, right? Obviously, to learn Forex and everything else, it's going to take some time. But once you do get it, you are now trading money for money, right? And the same way here, you sort of have a cap, right? You can only invest so much time. We all get 24 hours a day, right? You need some time for sleep, but you don't get any more time than that. And you can only make so much for each hour that you're putting in. Now, with this, the same way that you could have made $100 is the same way that later you can make 1,000, the same way that later you can make 1 million. All you have to do is, as soon as once you have more money, right, your money can start working for you and start generating more money. So that's why I believe it's probably the most efficient way to make money, and probably one of the best ways to multiply your money. Okay. So that's why I would highly suggest everyone watching this video to definitely stick to this path. It's obviously not going to be like extremely easy at first, but it is going to be the most rewarding thing you will ever do. Now, let's talk about exactly how you make money in Forex. What are pips? What's a lot size? A little bit about risk management. So let's start with how you actually make money. All right. So in Forex, I'm not going to show you guys a chart yet. Some of you may have already dealt with charts, but let's look at a chart. Sorry, I don't know why I drew this. Let's say we have some chart that kind of looks like this. Right? Let's start up here. Alright, so let's say this is a chart of, so in Forex stands for foreign exchange market, right, where you're exchanging currencies. So let's say here we're looking at a pair. So you always compare it in pairs, right? It's always going to be one currency pair and another currency pair. And it's always going to be 3 letters and 3 letters. So let's say we're looking at Euro USD, UST. So we're comparing the euro and the US dollar. So in this chart, what you're going to see is the rises is going to be the euro gaining power, the falls is going to be the euro losing power, and the US dollar gaining power, right? So euro's gaining power, US dollar is losing power. Euro is losing power, US dollar is gaining power, euro gaining power, euro losing power, euro gaining power, euro losing power, and US dollar obviously gaining power, right? So it's always a constant comparison of the two, of one going up and the other one going down, or one going down and the other one going up. All right, so this is what we're looking at here. That's what this chart is. Now, how does Forex actually work? So let's say we entered a trade here, right? So you can enter a trade at any of these points when the euro versus the dollar have a certain price, right? So let's say we just so happen to enter here, right? All of this hadn't happened yet. This whole right side, right? This is the future. So we didn't know this was going to happen. We just saw this and we're like, oh, it's going up, let's go in. Obviously, you're going to use a lot more than that. You're going to use technicals and all these other confirmations to enter. But let's say we entered here. Now, how do we make money? Now, let's say we stayed in the trade, right? And we went in for a buy. So you can either go in for a buy or a sell. Buy means that it's going to go up. Sell means that it's going to go down. That's simple. Buy means that you're buying euro and selling dollar simultaneously. And then sell means that you're selling euro and buying US dollar, right? But you're never actually touching the currencies. So let's just keep it simple and say buy means that it's going to go up, sell means it's going to go down. So we're saying it's going to go up. From here, we're saying it's going to go up. Did it go up? Ultimately, yes. It did go down some, but it did go up, right? So if we had stayed up to here, let's say we did stay up to here. Let's draw a line. So this would be the gain that we have had, right? From this point to this point. Now let's say the difference from this point to this point, just to keep it simple, was 100 pips. All right, so how do we make money? How is it that we've made money off this transaction, right? Let's say this time frame. This time frame was of something realistic. Maybe let's say it was 1 day. I mean, this 100 pips could certainly happen, and I've seen it happen in like 1 hour. But let's say it was 1 day, right? All these up and downs. So 100 pips. Now remember what we said. We have this thing called our lot size or our multiplier, which is what we decide to value each pip at. So we could have valued this at 10 cents per pip. We could have valued it at $1 per pip. We could have valued it at $10 per pip, and so on and so forth, right? I think you can go up to 10,000 or it's 100,000 around there, right? So how much could we have made? We could have made $10. We could have made $100. We could have made $1,000. We could have made 2 zeros. What is that? 1 million. Okay, so you could have made all this, right? Depending, it all depends how much you value it at. Now, why doesn't everyone, right? I know some of you are asking already, like, why don't I just do this all the time, right? I could make so much. Well, obviously you have to account for the losses, right? What's my potential loss? Because this trade, well, now we know it's going to go up, but what if it went down, right? What if it went against us? Or what if this little bit of down part, right, affected us? So let's say this down part here, I know it doesn't look very in ratio, but let's say this was 50 pips. Oops. 50 pips, right? So at the same time that we could have gained $10, gained $100, gained this 1,000, 1 million, right? So let's say this is our profit, and this was our downside, right? So at one point it was down a certain amount. It doesn't mean that that's what we were going to take as a loss. It just means that that's where it was at the moment, right? So it could have been, so if it's 50 pips, right, it could have been $5. it could have been here $50. Here it could have been $500, right? Because it's half. 50 pips is half of 100. Or here it could have been half a mil, which is 500K, right? So if you have, let's say my account is the size of, let's say I have an account of, let's say $100, right? If I have an account of $100, right, and I put 10 cents per pip, and at one point my account was -5, right? So at one point my account would have been at -5, which means that I would have been at $95 equity. So you have your balance, which is how much you actually have, and then your equity. Equity is what you would have if you pulled that at that moment. So if at this moment I got scared and I was like, oh no, I don't like this, I think it's going to keep going down, I'm going to pull out now. If I pulled out, I would have $95. Okay, so that's okay, right? If I have an account of $100 and I'm doing 10 cents per pip, that's okay, right? I have enough room for the negative. Now, would I have enough room for $1 per pip? Right? If I was doing $1 per pip, here my account, once I win, my account would have gone to 110. Right? In this case, at $1 per pip, my account would have gone to 200, would have doubled in size. But I have to be aware that at one point my account would have been at, my equity would have been at $50, which means that if I did decide to pull out there, I'd be at $50, right? If the trade did decide to go a little more down, I'd still be okay, but I'd be cutting it close, right? Because if this went down 100 pips, if this had gone down 100 pips, right, let's say maybe here, that's everything in my account. At that point, they're not going to let me play in the market anymore. They're going to kick me out because I don't have enough. What if it goes negative 101, right? They're not going to give me free money. So they always make sure that you have enough money to account for however low it's going to go, right? So yes, I could do $1 per pip, right? But then again, I could be down this much. I could have gone down lower. Now let's look at if I did $10 per pip, right? Had $100. Yes, I could have made $1,000. That would have been at 1.1K. But at one point the trade went down 50 pips. It went down 50 whole pips. So at one point my equity would have been down $500, right? But my account only has 100. So guess what? Once you get below 100, that's it. Your account is gone, right? And it's not even 100, right? Because they don't even let you get to the full amount, right? It depends on the broker that you have. So they won't let you get to the full amount. They won't let you go negative 100 if you have 100, right? Because they're risking it. Like, what if it goes down too quick, right? And the broker, they lose money. So they want to make sure that you always have enough to stay in the market. So this, if I was doing $10 per pip, as soon as it went down 10 pips, I would have been out. 10 pips times $10. Right, my account's gone. Okay, so this is why you want to ensure that you have enough for whatever it is that you're putting in. Right, recommended is 1%. So the lowest it should go is 1%. So if this goes down 50 pips, these 50 pips should reflect 1% of your account, right? So how do you calculate that? Okay, well, if I have a $100 account, then what's 1% of $100? It's $1. Okay, now this means that 50 pips should be equal to $1, right? So how much am I putting per dollar? Well, if I divide this by 50 pips, right, I would get, this is dollars per pip. How many dollars per pip per pip should I put in, right? Should I put in 10 cents per pip? Should I put in $1 per pip, right? We just divide. So let's divide real quick. Let's go to calculator. If we do 1 divided by 50, this is 2 cents, right? So 0.02 cents, 2 cents per pip. This is what we should be putting in, right? So that's 1%. Some people, what they do is they do around 3% risk, right? This would mean that 3% is equivalent to the 50 pips that you're willing to risk. So out of a $100 account, it would be $3. You divide $3 by 50 pips, and it would come out to 3 times that, right? Because this is 3 times. It would be 6 cents per pip, right? And what I do, this is just me, I do 5%. It depends on the trade, right? If it's a long trade that I'm going to hold for a long time, and it's a big risk that I'm taking, I'll probably do 1%. But typically, I like to do day trading, which is trades that only take 1 day, 2 days to develop. I'll do 5% risk. Okay. So with 5% risk, right? 5% is 5 times 1, 5 times, 5 times. So if I had a $100 account, right, my risk, I would be putting in 10 cents per pip. Okay. And I would recommend that this is the maximum you go. Alright, just to maintain the health of your account. So, now let's get on to the next topic. So for the next topic, let's talk about why is it that 90% of traders fail, and how to become the 10%. Now, you're going to see that trading is actually fairly simple. You know, it looks simple. It's not the hardest thing to grasp, but it's still fairly tough for 90% of traders, right? That's why 90% of traders fail. So why is it that 90% of traders fail? What can you do to not become one of these people? Right? One thing is the skill, right? So do you know how to trade? Do you actually know how to use technicals? Does your method, whatever method it is that you use, does it have some sort of consistent results, right? You're not going to win every trade, but are you winning either a majority of your trades, or whatever trades you are winning, are you profiting in pips, right? So all that matters is pips. Do you have profit? Okay. So whatever skill you're using, whatever type of way that you like to do your technicals, is it working? Is it giving you profits? Now, another thing is, here's the biggest one, psychology. Now, this is the biggest reason why a lot of traders fail. Why? Because we're humans and we have these things called fear, and so on and so forth, right? We have greed, we have overconfidence, cockiness, right? AKA emotions. And this is what messes up a trader. So what happens? Maybe you lose a trade and you're like, oh man, I still know it's going to go up. So you put in more and you're like, but wait, let me make up for what I just lost. So you put a bigger lot size than you were supposed to, and then you lose that. Maybe you keep trying to get it back, right? And what if you keep getting it's still a bad trade, and you're just insisting because you're letting your cockiness, your overconfidence that, yeah, this is what the market's doing. This is what I believe it's doing, right? Maybe you're not listening to the technicals. Maybe you're just letting it all go over your head, right? Or greed. Maybe it's about to hit wherever it is that it was supposed to hit, right? Your profit. It got to that point. It was about to get to that point, and maybe you move your target, right? You had it estimated to go to this target. You're like, no, it's going to go up a little more. Let me just move it, right? And instead of taking profit here at this point, you're like, let me move it to up here. And what if it goes like that and then it goes down? It never hit that point. And then instead of taking it out here or here or somewhere along this line, you're like, no, it's going to come back up. It's going to hit it. And then it keeps going down. And okay, I'll take it here at this point where I originally planned. But what if it never comes back up to that point, right? And then in the end, you're back at your initial, right? And you made nothing. Or, and even in worst case, you start moving your stop loss, right? You start letting it go against you. And you're like, no, it's going to come back up. It's going to come back up, right? And there you have a mix of greed and overconfidence. Or you have fear. Instead of following your technicals and letting a trade, maybe this happened to you in the past, and instead of taking it all the way here, you pull out early, right? Because you're not confident about your trade. And because you're pulling out early, right, maybe you're taking too many losses, and because you're taking too many losses, you're not taking enough wins, and in the end, you're not profitable. Yeah, you're playing it safe, but you're not profitable, right? And then let's say your trade does keep going up. You're like, oh man, I should have pulled out here, but whatever. Playing it safe, right? And then you're just not going anywhere because your losses are equal to your profit. So in the end, you're not getting anywhere, right? So it all comes down to your psychology, comes down to skill. So what we're going to help you out with in this course is partially the skills. Okay. We do have another course that we're going to talk about later that it teaches you more in depth about the skill, teaches you about how to handle your psychology. Another thing that's very important that I find in Forex that a lot of people don't talk about is support. You know, having other people that are taking on the same path as you, and they're also trying to learn Forex. They're also going through the same emotions that you are, right? And when you have that compassion, you know that other people are going through it, you tend to want to help them out, and in helping them out, you help yourself out in return, right? So that's another trick right there to be successful.